Hey everyone, welcome to our 2026 Midyear Outlook video. We hope you enjoy. So let's talk about the economy, stock market, and bond market for the rest of 2026, starting with the economy. Not many people feel like this is a good economy, but the numbers tell a different story. We have relatively strong GDP growth. We have low unemployment. And we have a strong consumer, one that has seen their assets largely increase over the last few years, whether it be investment accounts or their home values. And that has given the consumer the ammunition it's needed to take on the higher inflation on average at the grocery store or at the pump. You pair all of this with a massive AI infrastructure build out, and you have a lot of room for optimism. We talk a lot about what AI means for the stock market, but think about the impact on the economy. You have these AI hyperscalers, Amazon, Alphabet, Meta, Microsoft, Oracle, that are putting in a projected $750 billion into the economy to build out the AI infrastructure. Those estimates are predicted to be closer to 1 trillion in 2027. And when you build, these warehouses, you need someone obviously to manufacture your facility. You need someone to power that facility, to maintain it, to cool it. So you can really see the ramifications that this could have on the economy. And a good way to think about it is one company's investment is another company's revenue. We want to take a moment to touch on the midterm elections, which are coming up. Our friends at LPL Research project that the Democrats will flip the House of Representatives by a small margin, and Republicans will retain control of the Senate. Now, from a financial perspective, there's a few things you want to know about midterm election years. They're almost always more volatile, seeing the stock market fluctuate to a greater degree with the ups and downs. And then the average investment return tends to be muted. Since 1931, the S&P 500 has returned between 9 and 10% a year. In midterm election years, on average, it's half of that. So something to keep in mind as we progress through the remainder of 2026.
Let's move on to stocks and bonds. So far this year, it's been a really good year. In our outlook in January, we felt that it would be a good year, and we felt that we would see high single-digit returns for the year. We're already there. By the way, there were a lot of doomsayers saying that the market was sort of at the end of its bull market. We disagreed, and we also said that again during the war when we released our video in March. But let's take a look at what actually happened. We've seen 24 new all-time highs in the S&P 500. We also have seen 84% of all S&P 500 companies beat their first quarter earnings estimates. Very powerful. We think what will lead to a good market in the second half is a better macroeconomic information and a really more of a backdrop, and also continued artificial or AI spending. Our outlook for bonds for the remainder of the year is that they will stay higher for longer. Currently, the 10-year Treasury bond is at about 4.5%. Looking at this next chart, we can see that the anticipation of rate cuts were widely accepted up until about May of this year. And then there was a reversal from rate cuts to rate hikes. So the market is actually anticipating rate hikes going forward. For this year, we might see 0 to 1 rate hikes. Next year, we might see a few more. But a lot of it will depend on the price of oil, because that will impact inflation. And the Federal Reserve, that's what they're looking at, the inflation numbers. So we remain neutral. We don't believe the Fed will do anything this year, rate hike or rate cuts. And with that said, we would just conclude by saying fixed income bonds are very good in a portfolio because they will stabilize that portfolio during turbulent times. So let's stay positive on bonds and understand that rates might stay higher for longer. We hope you enjoyed our mid-year outlook. Have a great summer.
Take care, everyone.
Please take a moment to review these important disclosures.